I'm delighted to have Brian Davis on today. Brian is the president of Independent IRA, and I'm really excited because Brian and I have known each other for, probably 6 or 7 years now. He
Probably
really
longer than
was on, has it been longer?
that. I believe so.
Wow. Time flies. Well, COVID hit and everybody kind of went into a vacuum, and it seems like
Oh,
time
you
is
froze
just
up on me
crazy.
here.
So, um,
There you
I've been
go.
wanting to have this talk for a long time, Brian, because you are the expert on self-directed IRAs, definitely here in San Diego County. I trust your guidance, and I know a lot of people have a lot of questions. So with that said, Brian, how are things for you today?
Things are going good. Business has been steady through COVID and before COVID. Just helping some people this morning with some of their investments outside of the stock market in their IRAs.
Perfect. Well, that's why we wanted to have you on, because we know you're active. We know you're in the market real time. And, for a lot of people who don't know, we are getting a lot of questions. What exactly is a self-directed IRA, and how does it differ from a traditional or Roth IRA?
So that's a great question. So in the early 70s, Congress passed the ERISA Act, which kind of outlined the retirement system that we see today with IRAs and 401k plans. And when they created that act, they didn't really list, oh, these are approved investments. They really just said these are things that you cannot invest in, which are things like life insurance contracts and what the IRS deems as a collectible. One just has to have a custodian to hold these types of investments. So the industry is, not overrun's the wrong word, but the industry is dominated by the banks and brokerage companies out there that have securities, stocks, bonds, mutual funds, ETFs, etc. And so what some other custodians have come into play is to hold investments that are outside of the stock market that the brokerages won't hold, because the law allows that as long as you have a custodian that will hold that. And so the custodian I work with is AccuPlan with American Estate and Trust, and they're the custodian that I use specifically, and they hold non-publicly traded investments for people in their IRAs. We do not have a platform even for stocks, bonds, mutual funds, ETFs. So we're really there to complement people that have those IRAs with their brokerage or their bank, because we will hold those investments. And we do that we're not financial advisors. We're not investment advisors. We don't have security licenses. We're a platform for people that want to invest in things outside of the stock market in their IRAs. So just the same as Fidelity or Schwab has traditional Roth, SEP, simple IRAs, we have the same. But we're just there to fill the void of this alternative asset class for investments that aren't publicly traded.
Got it. So what you're saying essentially is you guys are only focusing on the items that can go in the self-directed, only focused on the real estate.
Yeah, real estate is probably the most common thing that I've seen. Precious metals, I don't see too often, but there are different areas of the country where that might just be more popular, because I know that's a big one. Everybody's probably seen those ads on TV, hold gold in your IRA and stuff like that. We do the same. That's just not been my, traditional client in the 14 plus years that I've been doing this. So yeah, we hold cryptocurrencies, precious metals, investments in direct real estate, investments in private funds. That's probably the most common thing I see, these private funds, and a lot of those are real estate related. We deal with people investing in startup companies and different safe agreements. So we really we just really are an option for people that might already be investing in those types of investments and allowing them to do that inside their IRA. So there's no tax distribution for anything like that. It's done inside their IRA.
So essentially anything that is kind of a tangible item, I'm sure that we're going to talk about some of the rules and restrictions, and we're going to really gear this around real estate. But it's so interesting to me that more people aren't doing this, being able to take money outside of their traditional IRA and then rolling it into more tangible items. But when you think about investing in real estate, what are the key benefits of using a self-directed IRA versus, say, just using your standard
It opens up
investments?
other asset classes. And if, you're a person that has a background in, let's just use real estate, for instance, this gives you that ability to invest in things that you might already know with your retirement account. And the one thing that gets brought up to me a lot, you don't have to do it with your whole retirement account. You can just bring over what you need for these types of investments and leave those more traditional security investments at your brokerages, at your Fidelities and Schwabs, et cetera.
Yeah, I know a lot of folks are heavy in equities right now, and of course everybody is on edge. It's October 2023. The market's been doing exactly what it's not supposed to be doing right now in this type of environment. It's going up. And it just seems like it's a good option for folks to go into something else, maybe take some of their current equities and diversify a bit and go into a self-directed IRA. So is there a minimum that you have to
No,
use
there's
to
no
start a
minimum,
self-directed
but
IRA?
most, like the custodian that I work for, American Estate and Trust with Accuplan as the administrator there, we're fee based. So we charge, $349.95 a year to manage the IRA account. There's a one-time setup fee of $50, and then the rest of our fees are transaction based. So really, if you come in with a $5,000 investment, is that going to make sense with those fees? Because we charge the same fees for a $5,000 account that we do a $500,000 or $5 million account. So it's really just what makes sense for that investor. Because, maybe they have a small Roth IRA, but they have some private investment that they think is really going to, blow up, so to speak. And therefore it's worth it for them to have that even with a smaller balance. But most of the time, my average client, I haven't looked in the last couple of years, but I remember a few years back, my average client would come over and then they'd bring over about $120,000 and they'd vest 100 grand. And then they would, leave themselves some wiggle room with another extra 20 grand in their account because something else might pop up for them. And they just want to have something in that account ready to get into one of these investments outside of the stock market.
So what type of real estate investments are allowed within a self-directed IRA?
Again, I'll go back to the ERISA Act and Congress. So it really didn't list what you could invest in, just what you couldn't. And that was life insurance contracts and what the IRS deems as a collectible. However, there's more nuance to that. There's what's called prohibited transactions in an IRA. So I'll try to use this least amount of my industry jargon as possible, but essentially your IRA is not allowed to do business with certain individuals. And that would be yourself, spouse, parents, grandparents, kids, their spouses, grandkids. So kind of the straight line up and down, your IRA is not allowed to interact with them. So it has to be a true investment to a third party. So very similar to probably, arm's length transactions, but maybe a little bit different. So when I talk to people, because again, I don't have investment offerings for people, I'm going through I'm looking to invest with this, with maybe this family member's involved or maybe not. And so I kind of try to help show them the rules and so they avoid any pitfalls. So, for instance, if I had a rental property in personally, I can't buy that off of myself with my IRA or put that into my IRA. So the rules are really for no self-dealing. So it allows these other investments, but it kind of carves out, hey, you're not allowed to personally benefit or those certain family members from the investments you're doing in your IRA. So, your spouse or something has an underperforming investment and you want to, hey, let's put it in the IRA for more of a long-term hold. We need some more liquidity right now. That's not going to work. So that's kind of my role, is to kind of help show people the rules, which, if you really want to look up the tax code, it's Internal Revenue Code 4975 that has a lot of these rules in it. But that's where I come in. I've been doing this since 2009. So again, like I said, I've been doing this for 14 years and this is all that I do.
When you're thinking about it, you're thinking principal and principal. So the the family member can't be the other principal in the transaction on the opposite side of where you're at, but you can invest with them. So if you have a family member that's looking to buy a net lease property or has some sort of development real estate property,
Yes.
you can be partners on that in a sense, right? As
Yes,
mutual
as long as you
investors.
partner, exactly. And as long as you partner from the beginning with them or even with yourself. So, for instance, let's say I found a property. I know I'm going to use some outdated numbers. Let's say a $500,000 property, and I had enough money in my IRA for half and enough personal money for half. So I could buy it as tenants in common with myself, but I can't change those percentages of ownership after the beginning. I can't make the offer in my name and then assign it over to my IRA. That would show like I'm giving credit to my IRA. So it does get a little tricky, but yes, you can partner with yourself, even if you're a prohibited, even if it is with yourself, as long as it's set up from the beginning. And a lot of people out there might have heard of like the Self-Directed IRA LLC, where people create an LLC that their IRA owns and they're an unpaid manager. This goes back to a tax case called the Swanson case from the late 90s, where if you set the investment up correctly from the beginning and you're still not receiving any personal benefit, you can partner with yourself. But going back to that example of buying that house 50-50 with my IRA and myself, because my IRA is 50% owner, I can't use that house. It has to be a rental property that way. So you don't get to skirt around any of these rules by setting up this investment. You still can't have any type of personal gain. So you can't buy like a property, a beach house somewhere in your IRA and utilize that. It has to be a pure rental. You can't even do the work on it yourself. You have to hire third parties to do any type of work. They consider that sweat equity, and that's something that's not allowed to do within assets in your IRA.
So I can see how that could be tricky because as an investment property owner, you're going to want to put some sweat equity. You're going to want to go check on it, do maintenance on it. And you're saying that's absolutely not allowed.
Correct.
So it sounds like it really has to be a very passive real estate investment.
Yes, I would agree with that.
Is that the key?
That is the
Got
key.
it. And so, you had mentioned also that you would partner with yourself. Now, what if you partnered with someone and then down the road bought them out? Can that change the percentage of ownership?
Yes, as long as they weren't one of those disqualified persons, the spouse, yourself, kids, or grandkids. If it's a third party, yes, that's not a problem at all. It's when you partner with yourself or one of those other, disqualified persons that I mentioned.
Okay, so if you did partner with a family member like a brother or a sister, and then down the road you wanted to buy them out, you couldn't buy them out.
You could. So this is where the prohibited transaction rules get a little weird. So spouse, parents, grandparents, kids and their kids, grandkids, so the straight line up and down, you can't transact with them. Brothers, sisters, aunts, uncles, cousins are seemingly okay, though there would be probably, if the IRS were to audit you, they might look at that with a little more scrutiny to see that there wasn't some, quid pro quo going on there where you are benefiting in the end and you're just doing it with a brother or sister as like a proxy type of thing.
Got it. Okay, so when you say straight line, that makes sense. Sorry, I didn't catch that. So
That's
parents, grandparents, kids. It's not horizontal family.
correct.
That makes sense. Yeah. Interesting. So are there restrictions with getting mortgages? Because I know that I've talked to people, and even with the prices, I mean, you mentioned a $500,000 purchase, that would get you half a condo here in San Diego County as it stands. So what are the restrictions with getting a mortgage? Is it the mortgage companies that have a problem with it, or can you get a mortgage if you're using your self-directed IRA for an investment?
Great question. So IRAs have some security for the IRA owner. So people can't really sue your IRA. So the loans have to be what's called non-recourse loans. So if I personally were to go buy a rental property, let's just say in Florida, myself personally, and I got foreclosed upon because I couldn't make the payments, etc., If the property wasn't enough to satisfy the lender, they could go after me personally. That's recourse. So with the IRA, since they have these protections, the loans have to be non-recourse, which means they cannot go after the IRA. So there's generally just a few lenders out there across the country nationally that do these non-recourse loans. I'll just name a couple: Titan Bank out of Texas and North American Savings Bank out of Missouri. They specialize in these non-recourse loans for retirement accounts, and they typically have a lot lower loan to values, that we'll see. So they'll typically lend up to somewhere between 50 and 65% loan to value. So you're not going to be able, because they're just going off the value of the retirement account and that specific deal. And the rates on those are, as you would imagine, a bit higher than you're going to get normally. And, this kind of brings in a whole other slew of issues here. So when you utilize leverage in an IRA account, so you're getting, debt financing. So there's this tax law out there called Unrelated Business Income Tax, or UBIT. And UBIT kind of has two structures underneath it. And this UBIT applies a lot to IRA accounts and to nonprofits. Essentially, and the part that we see most frequently is the part that's called UDFI. And again, I'm using jargon, but it stands for Unrelated Debt Financed Income. So my earnings are that on a property that has a loan on it are going to be subject to a tax based off of how much debt financing I used. So a lot of the good thing about it, though, is then you're able to have some write-offs in there because of the leverage. You're able to write most of that off, especially on a long-term hold where it still will pencil out for you. But if you're somebody fixing and flipping in an IRA, that tax is going to most likely get triggered. So that's one thing you have to worry about just a little bit.
My dogs start to bark when you talk about paying
especially
taxes.
in a retirement account. You're like, I thought these are not taxable instruments, but let's just say you're buying this $500,000 property. We'll go back to that example. And I got $250,000 in my IRA, and I get that non-recourse loan for the other 50%, at $250,000. You're able to generate more income from a $500,000 property than a $250,000 property. And, you're able to write off depreciation and things like that when you have a loan involved. When you're buying it cash outright, which is actually what I see the most, there's no write-off because there's no tax. Well, now that there is a tax, you can write this off through depreciation and the mortgage payments you're making, et cetera. So generally, it pencils out okay for you. It's just an extra step that you have to go through. You got to find the lender, deal with the lender. The IRA has to make those payments to the lender. So that's why, their loan to values are a lot lower than you're going to see out there. They want to make sure you have reserves in that retirement account to make payments. They want to see what type of rental income is going to come in, because the payments have to come from the retirement account.
So the retirement account makes the payments. Now, what about all the income that generates from that property? Does that have to go back into the IRA?
The IRA, tax deferred if it's in a pre-tax IRA like a traditional or STEP IRA, or tax free if it's in a Roth IRA, minus any of these other this unrelated debt financed income tax that it might trigger.
Understood. So what other tax implications for real estate investments are there within a self-directed IRA?
Yes, that's pretty much it. That's the main thing we see is the debt financing issue, and whether that comes into play, because the IRA is getting this benefit by getting this loan that the IRS does well, because you got in my example, 50% of this investment you're able to make was gone through a loan, which isn't really part of your IRA. We're going to look to tax 50% of that at trust accounting tax rates. But then after you work with a CPA or a tax attorney to figure out what that is, what you can write off, depreciation and the payments you're making, et cetera. Like I said, a lot of times it pencils out to, especially early on, zero or nil. It's It's when people are fixing and flipping that comes into play a lot more.
Yeah, I can see how that that would work, especially because there's so many different aspects involved. I guess that's why this next question, I kind of know where it's going, and I felt like this is where self-directed IRAs would excel. But what are the best suitable real estate opportunities when you're buying a self-directed IRA?
Well,
I think I know the answer at this
yeah,
point.
no, I
I'd
won't
rather hear it
say like
from
what's the
kind of
best
from your end.
investment for your IRA. I'm not, like I said, I'm not a licensed security.
No, I mean general fundamentals.
Yeah, I
Like,
would
is
say
it
one of the most
passive?
common probably
Is
investment
it
that I see are people investing in trust deeds or notes. So people are becoming the lender. So you're using your IRA as the bank. And a lot of times people team up with hard money lenders that have loans for people or that fractionalize trust deed investments, or people are buying, and obviously the market has gone up and down on this in the 14 plus years that I've been doing it. But, for a long time, their non-performing notes were a very large sect of investors. And then a lot of different real estate funds. So people might have, commercial real estate deals that are put together in a limited partnership or LLC, and the IRAs can become members or subscribers of those instruments. That's what I see the most. And a lot of those, you might have to be an accredited investor, you might not have to be. Um, and that's just what I see more than anything. I also see a lot of investments in startups, and whether that's Series A rounds, Series B rounds. Sometimes they're pretty new and they have these what they call safe agreements that we see a lot. So that's what I see most of. Um, and with the trust deed investment, there's there's not so much there's not so many, you kind of loan the money out and then money's coming back to you either on a monthly or a balloon payment at the end. So that's what I see more than people buying rental real estate. Though I have many clients that buy rental real estate directly into their retirement account.
And on that note, this next question is really about how is that process purchasing it? Are there any different nuances? And then what about managing it? How do you manage that property
Best
if you're not allowed to do any of
practice
the
is
sweat
to
equity?
use a third party property manager to get involved there. And the property manager can handle a lot of the small transactions so money doesn't have to go in and out of the IRA constantly, especially with somebody that has, more than one property in their retirement account. Um, so that's probably the best practice, though. You can do it as long as you're segregating all the work out to third parties, as long as you're not doing the sweat equity. So I do have some people that do it themselves, but they just have to be clear. Hey, you can't go in there and fix the sink, fix the toilet. You just got to go hire the third parties to do it. And then, the rental checks go back into the respective retirement account.
Are there any different setups when you're buying the property?
Good
Do you get
question. So our
additional paperwork?
custodian,
How does that process work?
we allow the IRA owner to sign on the IRA's behalf. So, for instance, I had a client last week who's looking to buy a rental property in Vegas. He made the offer in the name of his IRA account. He provided us that offer, and with the offer, there was the request for a $10,000 earnest money deposit. And so the client then provided to us one of our forms called a direction of investment form, saying, I want to invest in this property. I need to send a $10,000 earnest money deposit per this purchase contract. And we sent out the $10,000 earnest money. And then for closing, the client's going to sign the closing docs on the IRA's behalf as well and provide us that settlement statement showing, we need X amount for closing. My example from the other day wasn't finished yet, but generally we see that settlement statement provided, and we'll send the rest of the funds there. And then that property on, 555 Main Street or whatever is the asset in that client's IRA.
And how quickly do you guys turn around those funds? Is it cause a, I'm a real estate agent, so we're watching that close of escrow date like it's the coming new year. So when you guys get involved, is there do you have a 24-hour turnaround, a 36-hour turnaround?
So it depends, obviously, if the client has money in their account. So my example from the other day, the client had enough money for the earnest money in his account, and so we were able to send that payment off within 1 to 2 business days. I think we did it in one this time, but depending on the time of year and how busy we are, that can be 1 business day, that can be 3 to 4. And then right now we're working on transferring his retirement funds from a different IRA over to us so that then we can do the closing as well and send those funds out. I've had people that had all the money in their IRA accounts. They weren't going to do an earnest money deposit, and were able to fund the whole transaction within like 2 to 3 business days. So no 30-day escrow in that case when the IRA money was with us. It's when the IRA money's not with us and we got to work on bringing it over from the other IRA account. That usually is the longest part of the process.
So in that scenario, you're bringing it over from Fidelity or something. They're transferring it over to your guys' accounts, and then you guys transfer it over to the escrow company for the funds. How long does it take for you guys to get funds over from like a Fidelity? Is it a big process or is it pretty simple?
So we have a form of ours called a transfer request form, and we do what's called a trustee to trustee transfer to request funds going from, in your example, Fidelity over to our custodian. And so the client needs to make sure those funds are liquid. So they might already be liquid, or it might take them 3 to 4 business days to liquidate what they need over there. And then we send the request, and a lot of the major companies, the Fidelities and Schwabs, are generally just a couple business days, but some banks and other institutions can take 2 to 3 weeks. So that's the longest part of the process generally, is getting that money from wherever it is over to us.
Yeah, it definitely seems like there's going to be a focus on timing. I guess that's what you guys do on your end is help quarterback all of these items. What are the biggest pitfalls you see, or the biggest mistakes people that are getting into self-directed IRAs run across, or maybe have the worst, poor expectations on how things are going to work out?
Yeah, let's just say they get involved with somebody in a real, maybe it's a real estate deal or not, that is a friend or think that they're a friend, and, things don't work out, and maybe they did a note that wasn't secured by a trust deed or a mortgage, and they just do a straight personal loan, which you're allowed to do in your IRA, and them not being able to make those payments back. So it's really on the client, the IRA owner, to do their due diligence on the investment itself and make sure that they believe it's going to get paid off, or they have to be willing to go, hey, I invested in this little private startup. I knew I had a shot here where it wasn't going to work out. So it's really people getting to know what investment or investments they want to make and how secure those investments are. Because we're a non-fiduciary, we're not securities advisors. We don't have investments for people. People come to us with those investments. So it's really on to them as to do their due diligence on that investment to see that it's going to pay off.
So are you considered the custodian, or what would your company be considered?
I work directly with the custodian. So I'm kind of the intermediary between the client and the custodian. So I'm filling out all the custodian paperwork for the clients, or helping them fill out our custodian's paperwork. Like I mentioned, our direction of investment form and our transfer request form. So I am, it's kind of like an insurance agent, like a captive insurance agent, and I'm helping with the clients and the agency.
So if people want to set up a self-directed IRA, they reach out to you and you'll help them get all that set up. You'll connect them with your custodian. You'll reach out to whoever their investment company is. And what's the best way for folks to get in contact with you, Brian, if they want to set up a self-directed IRA?
Yeah, they can find me online in a couple of ways, independentira.com or acuplancalifornia.com, or reach out to me by phone, 619-432-4555, or email, and I already gave my email addresses there. So those are the best ways.
Perfect. And we'll put all that information down in the description below. And Bryant, this has been great. These are becoming more and more popular, especially as people are wondering what they're going to do with their bloated equity accounts and want to diversify. And of course, real estate is pretty strong. So thanks for being on the podcast. And again, we'll put all your contact information down. If you're interested in a self-directed IRA, I encourage you to reach out to Brian and ask the questions, get something set up. Brian puts the I in IRA. I had to include that.
Thank you, Doug, and look forward to seeing this when it's finished.
Absolutely, man. All right, take care, everybody. Thanks a lot, Brian.
All right, thank you.